How to maximize your charitable giving. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. I've done a couple videos on this in the past in maybe different contexts, but I want to revisit this as end of the year tax planning, just top of the mind awareness for me. And I was just talking about qualified charitable distributions as well as a video we did the other day. So I want to go over to this a little bit more in detail because I think it's pretty interesting. So we're going to talk about that here. Don't forget to subscribe down below if you like what you see. And of course, comments, thumbs up always help me a lot. All right, so here we got well, we're going to say a married couple. It doesn't, in this stage, won't matter, but we're just going to say a married couple. It actually doesn't matter. It could be single. It literally does not matter. We have goals here. We want to leave some money to the kids, and we want to leave money to the church, or it could be the SPCA, it could be any charity. But you have an individual, and again, in this case, it doesn't matter if you're married. You have somebody who has a goal to leave money to the church and leave money to their children as well. It could be a widow, it could be a divorcee, or just you want to leave money to somebody. We have a $100,000 IRA, and we get $100,000 in a taxable account. All right, so two accounts, $200,000 in total is what your net worth is, and one is an IRA and one is a taxable account, i.e. taxable, you get a 1099 at the end of the year. Heaven forbid that's in municipal bonds, but we'll talk about that some other time. I've talked about that before. Don't do that. Don't have municipal bonds in a taxable account. Anyway, so what should we do here? So the first question is, what is preferable to leave? All right, now we're going to say for simplicity, all of our income needs are met. Everything's met. We're not going to talk about required distributions in this one here. But go to the next video I'll do after this to show you about how RMDs play a role. But what's the best one to leave to church, and what's the best one to leave to charity, to your kids? You ready? So I'm at the quiz. Did you answer it? So of the two, you have an IRA and a taxable. Which one should your kids inherit? Did you say IRA? Wrong! Wrong! They should inherit this guy right here. Did you say the church should inherit the IRA? Right! Right! And let me just do a brief thing. I'll show you why here. What color? I'm going to get purple. All right. So the reason is because when the church gets this, tax free. When the kids get this, or it doesn't have to be children, it could be your old buddy Josh. You want to leave this to me via your will, or a transfer on death arrangement, or a payable on death arrangement, depending on what type of account it is, tax-free under current tax law, and there's no one saying this is going to change anytime soon. So when the church inherits your IRA, it's tax-free. When the kids inherit the taxable account, it's tax-free. Now, let's keep going with this scenario here, because I want to show you it gets more than just that. All right, now we got 100,000. So you're setting up your accounts, your charitable distribution plan of action. So you say, okay, I got some charitable distributions in mind. So I have $100,000 is what I'm anticipating, is what my IRA is worth now, and I'm going to say it grows to $200,000 in 10 years when I die, and now I'm dead. Remember, like they used to do in the old cartoons? Now I'm dead. And this guy's also grown to 200,000. Same thing, 10 years. What do the church get? The church gets $200,000 tax-free. What does the kids get? $200,000 tax-free. Because of the step up and basis rules. That means whatever my date of death valuation is, that's what my heirs will receive as their cost basis. That's the step up. What it means simply, and I say this a lot on the YouTube channel, and I'll say it till I'm blue in the face because everyone needs to understand. When my kids, when an individual, a human being, inherits a property outside of an IRA, in a taxable account, the property value steps up in terms of the cost basis to the date of death valuation of that day, which is why it's so important to make sure your custodian, the Vanguards, USAs of the world, provide you date of death valuations when you die. It's insane that some of these guys don't. But anyway, so $100,000, it grew to $200,000, and I got hit by that bus. That's my date of death valuation, which is the cost basis my children inherit this property for, $200,000. If they sell that tomorrow at $200,000, they owe no tax. If they sell it at 210, they owe 10,000 capital gains on that 10,000 because their cost basis is $200,000. Does that make sense? That only works here. On the tax deferred account, the IRA, if they inherited this right here, they have to pay income tax on the entirety of the account because it is what's called IRD, income with respect to decedent. Someone's paying tax on this money. It's not just on this, it's on the entirety. So now they inherited $200,000 in an IRA. They have required distributions. We know that going out the gate. And on top of that, they have to pay taxes on anything they take out, be it the entirety or the RMDs. In fact, if they took out a full $200,000, I guarantee it's going to put them in a higher tax bracket, which means they're going to have to pay even more taxes. So we don't want that. So now if you leave it to your kids tax, or you leave it to the church, your church inherits the entirety all tax-free as well. Hope that makes sense. But we're not done yet here. Let me get my trusty. So you want to make sure your children get your taxable accounts first and foremost, and you want to make sure, if you are charitably inclined, that the church gets the IRAs, the 401ks, the 403bs, and whatnot. That's how you want to do it. Now, obviously, a lot of people's IRAs are worth more money than the non-IRAs, and so you're going to have to think about how do you want to do that. Well, maybe start pulling more money out of that while you're in a low tax bracket. Lots of strategies in charitable giving. Don't just say, I'm just going to take the minimum, because I don't want to pay tax. Oh, my friends, if you are in a low tax bracket and your intentions are to leave that to your kids, and your kids are in a high tax bracket, you aren't doing anybody any favors except for the IRS. Take advantage of your low tax brackets. Please take advantage of it. All right, so let's go to the next video. So hang in there. Go to part 2 of this. Going to run a different scenario on what you can do when it comes if the bulk of your money is in an IRA and you're still trying to leave tax-free money to your kids. I'll show you here in just a second. So stay tuned. Don't forget to subscribe and then thumbs up and comments. We'll see you here in just a bit.